In this video, we are going to work problem E14-21 from page 777 of our textbook. This is, I would say, somewhat more like what we'll do on our exam, exam 7, and the final. You'll have one of these on there too. So we're going to prepare the operating activities section of a cash flow statement, and we're going to do the indirect method. So to do that, we need an income statement, which we got here, and we need a comparative balance sheet. So as you can see, we have, it's really not set up in a balance sheet format, but we have the accounts and their balances across 2 years. So we can calculate what we need, and this is a little bit more like what we would do for the exam. I'm going to give you income statement, balance sheet, and say, do the cash flow statement. Well, just the operations section. All right, so we've got some other stuff that this stuff doesn't really have anything to do with us because we're only doing operating sections, right? So plant assets, that's investment, cash receipt, no gain or loss. So if there was a gain or loss, that would be up on the income statement, but it's not, so we don't have to worry about it. Common stock, clearly that's financing, right? So this stuff doesn't go in the operations section, so we won't worry about that. Okay, so let's get started. So we know we've got to put a title on this thing, so it's Boost plus Inc. Cash flow statement. And I'm going to put partial here because we're only doing the operating income section, and it's for the year ended September 30th, 9/30/18. All right, so we start out by writing cash flows from put our titles, right? Cash flows from operating activities, and you always start with your net income. So bottom line of the income statement, there it is, $53,000. So net income. Okay, so there's a good start for us. And that's why this is called the indirect, because we add and subtract from net income to come up with the cash flow. All right, and then of course you have to do your adjustments, right? So we're just going to say adjustments to reconcile net income to net cash. All right, and now the first one is always depreciation expense. Do we have that? Yep, there it is. Depreciation expense, plant assets, right there. Okay. And it's $27,000. And of course, you always add back in depreciation because it's a non-cash expense that was took out, so it shouldn't. We don't want it messing with our cash flow, so we add it back in. It shouldn't have come out in the first place if you're just tracking cash. Okay, so now we go to our balance sheet, all right? And we look at the changes across the different years for current assets, right? In the operations section, we look at current assets and current liabilities. Right? In investments, we look at plant assets, and in financing, we're looking, of course, at equity and long-term liabilities. So that's where we get the numbers for those other sections. But this section we're doing, operations, comes from current assets and current liabilities and the changes, and other than cash, right? Because cash is what we're reconciling to. The whole point of this is we're trying to reconcile this to this, right? Where did those cash flows come from that changed us? So we got to leave the change there out of the picture. But starting with current assets, we have accounts receivable, and this is 2017, this is 2018. So they decreased, right? Accounts receivable decreased right, by $15,000, right? So that's a decrease in accounts receivable, and because they decreased, we add them back in, right? So that's 15,000 we're going to add back in. Why? Well, think about it. Cash came out, right? If your account receivables went down, that means cash flowed in. So that's the way it's going, so we add it back. Next, merchandise inventory went from 88,000 up to 94,000. It increased. So we have an increase in inventory. And so if you think about the cash flow, how would it flow? Well, if inventory came in, right, it increased, you had to pay for that, right? So cash flowed out. So that is why we're going to subtract the difference, right? 94 minus 88,000 is a decrease of 6,000, is an increase of 6,000. So because it's an increase in a current liability, we subtract that 6,000, right? And that's all the current liabilities. We don't care about PP&E, that goes in investing. All right. The only thing I would want to mention about the PP&E from a balance sheet is don't pick up accumulated depreciation, right? This right here is depreciation expense. Comes from the income statement. So next we're going to look at current liabilities. We got two, accounts payable and accrued liabilities. So accrued liabilities are, those adjusting into the end of the month that you accrue. Things like interest payable, salaries payable, taxes payable, unearned revenues. So accrued liabilities and accounts payable. All right, so looking at the difference between 2017, accounts payable increased by 17,000. Okay, so we have an increase in accounts payable. And so because it increased, you add it, right? It's the opposite of liabilities. All right, so increase in liabilities, current liabilities, you add. I guess you can kind of think about it, oh, that's cash I didn't have to spend, right? If they increased. Cash I didn't pay out. Accrued liabilities, so we went from 20,000 to 12, so that's a decrease. If you think about it, and to get rid of liabilities, you pay money, so cash flowed out. So that's 8,000, and so a decrease in accrued liabilities was a decrease of 8,000, right? So that's flowing out, so subtract it. So we've got plus 27, plus 15, minus 6, plus 17, minus 8. So add, subtract, and you're going to come up with $45,000. And that's a positive number, right? 27,000 plus 15,000 is 42 minus 6 plus 17 minus 8 equals $45,000. And we're going to add that, right? Because these net out to be 45,000. So that's the net cash flow, 53,000. Net income plus 45,000 is equal to $98,000. Right? And that is what we call net cash provided by operating activities. Net cash. So that's it. So that's the whole deal. The thing people have a hard time remembering is that current assets and current liabilities flow the opposite. But when you think about it, it makes sense because they're on opposite side of the equal sign, right? Assets equals current liabilities plus equity. So they flip, right? Even how we flip, how we do the debits and credits. So just remember, decrease in current assets, you add. Increase in current assets, you subtract. Increase in account payable is you add. Decrease in current liabilities, you subtract. All right, so that's it. And always subtract, always add in depreciation expense. All right, that's it. Go try the lab, and I think it'll make some sense.